Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein of Linn & Associates with your metals market update, and this is for Tuesday, the 23rd of January, 2018. We're just after 4:30 p.m. Central Standard Time. And while you see a nice close in gold, I'm telling you, this market was up near the day's highs. Silver market was almost 10 cents, maybe 12 cents higher than this, going right into the last trades of the day. So when we reopen at 5 p.m. Central Standard Time, look for a pump in this market. In fact, most of the metals came back up. Copper got hit because at the LME, London Metal Warehouse stocks area, big build in stocks. What's going on there? Is China not using the metal? What's taking place? And traders are wondering. Plus, we're starting to hear from Chile that they're looking for a year where they still have more supply than current demand. So another thing to be worried about, and Chile's a major producer. But in the gold, I am still very enamored with the fact that what I sent everybody, maybe I'll send it again, our price counts on gold are being validated to the upside, and they're still saying higher prices are coming in this longer term. So I like what I'm seeing there. In the gold, you broke a little yesterday, you've come back up, and for the weekend, you're up 360, and I'm telling you, you're higher than that when you'll see how we reopen tonight. I'd like to see this thrust get over the last thrust high. Wouldn't like to see the market stall here and then start down again, but the bias is up as you're over the 18-day moving average of closes, and as you can see, the market's in a very nice position here. Now, on the charts, one of the things that you can almost see is a visual line of support. You see that? It's pretty much right there. Yesterday, when we were looking at this chart, I said you can almost draw a downtrend line in an uptrend line. You can visualize it, and if I start putting all this in the charts, it gets pretty busy. But the market's not looking bad at this point. I go to the swing lines, and the swing lines today, not yesterday, now confirm you're back in an uptrend. Higher lows, higher highs. If I remove this action, I can visually see lower highs and higher lows. Yes, the legacy starts with making the pattern of higher lows and the higher highs. But I always pay attention to what's currently going on. And you had to take out 1342.70 and not break through these lows right here in order to convince me that the market was trying to move up again. That's exactly what occurred. The support of the market's the 18-day moving average of closes in red. The green line is the 100-day moving average. When you take a look at big support, if you're to fall back, you have a combination of the 100-day average and the lower Bollinger Band together. And the next immediate upside target as well, you can see it, 1352 and a fraction. When you look at momentum, you have an overbought market. This is the part that bothers me. You're overbought. Second part that bothers me, may not be a bad thing. You lost the embedded reading right here. You came down, didn't make a run for it. You have to go over this high now to tell me the odds are you're not going to come back for that number on this particular reading. It's rare that that occurs, but it's also a sign of strength. Think of cotton when it did this and it didn't return to it. So you always look for something that doesn't follow the typical pattern to give you an idea. Now let me explain the importance. Am I thinking even remotely the bear side of the market? The answer is, from my point of view, never when you're over the 18-day moving average of closes. I have an immediate upside bias. Never when I've got the swing line making higher lows, higher highs. So even though this is there, and it doesn't mean I'd come out and tell my traders, in fact, I'm not going to tell you what I tell my subscribers to do or not do, but the momentum certainly to the upside still. In Bitcoin, the market's Came down, as you know, got through the 10,000 level, has rallied back up about $2,000 from there. Still volatile as can be. The contract that has got the volume and open interest building more than the CME Group's Bitcoin contract is the CBOE. When I checked it yesterday, it was over 10,000 in open interest. So the market is getting maturity to it. Now, you're going to still ask me, why am I still showing 15-minute charts? And the reason is I probably need a full another month of data. And then I'll have enough data where I can start filling this in for you. The March contract will probably offer that to me sometime in late February. Okay, remember, these are brand new futures contracts. I can't just pull the data from somewhere. The gold-silver ratio, look at how silver is losing to the gold. But you knew this. You started this pattern of the higher lows, higher highs back here, and we had pinpointed that this market had run its course down here. Will it get back into this area? I'm going to repeat again. The 80 number is a historically high number. 80 ounces of silver to get 1 ounce of gold is very high historically. Go do your research. You find out for yourself. So then we come over to the GLD contract. And GLD had a good day, just like the futures, but it's doing something else. Let's go first to the slow stochastic, if I can go back. It may not let me. Sometimes the stock charts are just a little different than these. I'm going to try it one more time. There we go. Know if I'd get off it. Here we are. And the market loses its embedded reading. Do you see the red line here is 79.54? Before that, the red and the blue were going sideways over 80. It loses it the second day. That means it has to go through the whole process again. Today, both numbers finally get back over the 80 level. That was Monday. Today, they're day 2 of it. Guess what can happen here? This market, and I always tell you, you got to look at both the futures and GLD. If this market embeds, it carries the day for me for the futures contract. Even though futures won't have embedded, they can't. If this does, it's a sign of good strength, and again, you might be headed to this number. So I like what I'm seeing here. When we get to the GDX, yesterday's action, and let's see if I can get you to it. I often have to get off the chart and back to it to back it up on, because it just loaded, as you saw. Lower highs, lower lows, you had gotten down, and today you extend the low and pop back up. So we've negated the downtrend. That's number one. Number two, this pop up puts in play 24.29, about 20 cents higher on GDX, about a 1% gain that I'd be looking for in the market. And that's where I think the market could see its first resistance. It was not weak enough to get down to the 100-day average, which I find interesting. So what do I look for? I look to see is momentum turning. And momentum turned up. The red line got back over the blue. So metal markets, at least the gold sector, is looking better. In silver, the battleground's going to be the number right here at 1707.10, the 200-day moving average. What I loved today, and if you get my report, I said silver had a washout break and that might be it. Why did I say that? If you take a look, you were sideways. If you break through 1691, you're going to set up the pattern of lower highs, lower lows, with the lower Bollinger Band being the objective. The market is not yet oversold. Today's action, when you were down there, you were definitively oversold. But the market rallied back smartly, so the slow stochastics adjust to that. So we're still in this area of the resistance, get over 1713, and what you probably do is wake up a group of traders that say, hold on now, we're developing this whipsaw sideways action in here, doesn't mean anything, and because of the 200-day average, I think other traders will take note of it. There's a lot of people that watch moving averages. In the copper, with the big washout, look where you went, the 100-day average. And if we take a look, here was the market on Monday. Today's only Tuesday. The first target is if it goes down, the lower Bollinger Band is your first support. What would be the second support on the chart? The 100-day average. Are you oversold? Absolutely. Are both numbers under 20? They are, but it's only the first day of it. So the market continues the oversold stance, falls, gets underneath on a washout to the 100-day average, and then bounces off of that a little bit. So, well, actually, it didn't. It closed under it. I want to say that. Closed right under it. Will it bounce a bit from there. That's what I meant to say. Again, my brain's faster than my tongue. And if it does, look for resistance between this number and the 18-day average of closes. If it lets loose from here, then the goal is how far can it push the Bollinger Band and say, we have entered a bearish trend in this market, and it looks to me like it's going back down. In the platinum market, you went through this important low yesterday. You followed through, didn't have any downside traction to it, and you've kept the embedded reading. Is this a trap for the bears or not? The bias remains up because you're over the 18-day average, and at the end of the day, until you lose the slow stochastic, the 18-day average is not in play. In the palladium, it's different. When you lost the embedded reading way back here, this is when the market put into play the 18-day average of closes. You had the close. If you rallied back up the next day, you'd lose that, but you didn't. You stayed down. Like the gold market, that often puts the 18-day average in play. But instead, this market came all the way back up through that high. That wipes that thought out. Doesn't mean it still can't do it, but not off that initial thought of mine. Fails at the upper Bollinger Band, works its way and eventually gets to that number. But I'm telling you, I would not have expected a new high off of losing that. And now the market is what? Fighting a battle right here, looking for its next set of direction. Dollar index still working its way down, lower highs, lower lows. So you put it all together, you have an interesting time. Is inflation worldwide going to pick up, as Gary Cohn mentioned in a White House conference today, to try to get what? To try to get the marketplace, if you will, thinking that we're going to see higher wages and more labor participation. You're seeing the cover here, and I'll bring this back to you, of Modern Trader magazine for the February issue. We make this available to you totally free. It's a $79 a year offering. If you go to them and sign up for it, and do that, I'd like them to get the revenue. That's what you'll pay. It'll come to you by email. We'll get it to you the same way. And yes, they'll send it, not us, by the way. 3% GDP call. What's the Dow doing? You tell me. And that was their cover of it. North Korea, Fed policy coming up. And Fed policy is right in front of us because you're now going to have your nominees moving forward. We need another vice chair coming in. So you're going to get all these interesting things coming at you. And this is how it looks. It covers Forex. It's going to cover derivatives. It's going to talk to individual stocks. You're going to have ETF talk in this. You're going to talk industries, options trading, Bitcoin trading. All of this is covered in a fascinating read in most of the issues in some way. But then you get the meat. The meat, to me, are these articles right here on different technical studies. I love to read those because I can get fundamentals anywhere I want, but not these technical stories. And of course, then there are other takes after the markets, and what do? This is how a typical issue looks like. And yes, you can print it, you can read it. The reader is the best reader I've seen on the business that they have. Here's a stochastic strategy. And then daily, you get the daily market focus coming at you, which is their daily magazine, all coming into your email. How do you get it? You give us a call. You go to our website. You can click up here if you're watching me on YouTube, or underneath us at any point. All you need to do is click here and go where it says. You'll come to our forms, fill them out. I'm Ira Epstein. You have a good day.